dive into my main focus point today, which concerns this headline. Trump's tax bill could raise taxes on foreign companies. And what are the ramifications of that? And so in order to understand that, we need to dive into Section 899 of the Big Beautiful Bill. It's a provision in the House-passed tax bill that would impose pretty steep taxes on foreign companies if their home countries are deemed to impose, quote, unfair foreign taxes on the United States. Now, at first glance, that sounds pretty decent. But the problem is Europe, which has digital service tax revenue, could be a target here. And in turn, that could discourage foreign direct investment in the United States. Now, Ernst & Young estimates Section 899 could cost the U.S. 360,000 jobs and $55 billion in GDP annually over a decade, essentially wiping out 1/3 of the projected tax growth from tax cut induced growth from this bill. And so you're starting to see a lot of backlash from businesses, understandably. You're seeing Toyota and Nestle and the Global Business Alliance coming together and trying to lobby and say, listen, this is not a good thing for, of all people, American workers. This report showed that, or rather estimated, right, because these are all estimates, that Florida could lose as much as 44,000 jobs. Pennsylvania could lose as much as 28,000 jobs. North Carolina could lose as much as 24,000 jobs. And Michigan could lose as many as 23,000 jobs. So obviously if you heard which states I was talking about, some pretty crucial political swing states. Now, Trump is arguing that his tax and tariff plans will actually attract more investment. But if you're looking at data for the first half of the year from new construction of factories, federal construction data, factory builds, you're not really seeing it. You're seeing anywhere between a 20 and 30% decrease in new investment. Now, Section 899 kind of does this thing where it pits this protectionist idea of we think things are unfair against the goal of boosting international investment into the United States. And that's because that 30% tax rate could apply pretty broadly to profits from companies, to non-citizen employees within the country, complicating the picture, right? Running the risk of arbitrary enforcement. Financial industry groups warn the rule could choke capital markets and hurt retirement savers. If there's less investment in the United States, most people's investments, of course, in their 401ks and their IRAs, their Roth IRAs, that hurts corporate earnings. That hurts what a lot of people rely upon for retirement. Now, obviously, this is not a done deal here. The measure's future rests within the Senate, within the reconciliation process. And it's important to note that key senators, John Thune, have not yet declared where they will go on this vote. But the reason this is important is not just because of the ramifications broadly, but of trying to understand the different effects that changes in tax policy could have and how that might affect your retirement accounts, your retirement savings, but where you might want to allocate money going forward.